Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings to uncover the real stories behind the numbers. In this episode, we're digging into PennantPark Investment Corporation's recent 8K filing, which gives us an early look at their financial performance as of the end of 2025. And let me tell you, there are some interesting moves happening. Before we dive in, if you want more straightforward and unbiased financial analysis, make sure you hit that subscribe button and join our growing community. Also, if you want to chat with us and other viewers about these companies and much more, join our Discord server, linked in the description below. So, what is the big news from PennantPark? Well, as of the 16th of January 2026, the company dropped some preliminary financial highlights for the quarter ending the 31st of December 2025. Think of this as a sneak peek before the full official report comes out, and it gives us a chance to see what has been cooking behind the scenes. One of the most significant events highlighted is the sale of their equity investment in JF Intermediate LLC in December 2025. They sold this for a cool $67.5 million. What is really notable here is that this sale generated a realized gain of $63.1 million. That's a massive profit, and it's pretty much in line with the investment's value at the end of September 2025. This single investment represented a chunky 23% of their equity portfolio at that time. So unloading it like this is a big deal. It means they successfully cashed out on a substantial asset. Another major development was the amendment and extension of their credit facility in December. This is like upgrading your company's credit card with better terms. They increased the total amount lenders are willing to provide to $535 million, up from $500 million. Even better, they managed to lower their borrowing costs. Instead of paying SOFR plus 2.35%. They'll now pay SOFR plus 2.10%. This might sound small, but on large sums of money it adds up. Plus they pushed out the period they can borrow money in the credit facility to 2029 and the final maturity date to 2030. This gives them more flexibility and a longer runway to manage their finances. Now let's talk about the numbers that directly impact shareholders. For the quarter ending the 31st of December 2025, their net asset value, or NAV, per S-Hair is estimated to be between $6.97 and $7.02. This is a slight decrease from $7.11. Per S-Hair back in September 2025, the filing explains this dip is mainly due to distributions they made that were more than their investment income. They also mention a one-time expense of about $0.03 per S-Hair related to that credit facility amendment we just talked about. So while the overall business might be chugging along, shareholder value per S-Hair has seen a minor pullback. Looking at their earnings from core operations, their net investment income for the quarter is estimated to be between $0.13 and $0.15 per S-Hair. This figure is adjusted to exclude those one-time expenses related to the credit facility amendment, which amounted to about $0.03 per S-Hair. This gives us a cleaner picture of their recurring income generation. It is a bit lower than the $0.15 per S-Hair they reported for the previous quarter. The total value of their investment portfolio, at what they believe it is worth, was about $1.2 billion at the end of December 2025. This is down from $1.3 billion in September. This decrease can be attributed to a few things, including the sale of the JF Intermediate investment we mentioned earlier, and likely some market fluctuations. An important metric for companies like PennantPark is the number of loans that are not paying interest, called non-accrual loans. At the end of December 2025, they had 4 loans on non-accrual, making up 2.2% of their portfolio based on what they paid for them, and 1.1% based on their current estimated value. This is up from September, when they had the same number of loans, but they represented a smaller portion of the portfolio. This indicates a slight increase in the risk profile of their loan book. Let's talk about debt. PennantPark had about $611 million in total debt as of the 31st of December 2025. This includes money borrowed under their credit facility and 2 sets of notes maturing in 2026. Following up on debt, their debt-to-equity ratio is now estimated at 1.34 times. This means for every dollar of equity they have, they owe about $1.34. This is an improvement from 1.60 times in September, suggesting they've either paid down some debt or their equity has grown relative to their debt. Finally, cash on hand was about $46 million, and they had significant unused capacity under their credit facility, around $239 million. This means they have a good amount of liquidity available if needed. Now, let's put all this together and think about what it means. On the positive side, PennantPark has demonstrated its ability to generate significant gains through strategic sales. Like the JF Intermediate deal. They've also successfully renegotiated their credit facility, securing more funds at a lower cost and extending their repayment timeline, which is strong financial management. The slight improvement in their debt to equity ratio is also a good sign, showing they are working to deleverage. However, we do see a slight dip in net asset value per S-share, which is always a concern for investors. The increase in non-accrual loans, while still a small percentage of the overall portfolio, warrants watching. It suggests that some of their borrowers are facing tougher economic conditions. The core net investment income, while stable, isn't showing strong growth quarter over quarter, and this is where the company generates its primary income. Looking ahead, the company seems to be navigating a complex financial environment by actively managing its assets and liabilities. The successful sale of a major investment and the refinancing of their credit facility are testament to their strategic agility. The key will be how well they can deploy the capital from those sales into new investments that generate consistent and growing income, while also managing the risks within their loan portfolio. The slight decrease in NAV and the rise in non-accrual loans are cautionary signals, but they don't appear to be immediate red flags given the company's overall financial strength and liquidity. Alright, that is our breakdown of PennantPark Investment Corporation's latest financial update. What is your take on these numbers and what they signal for the company's future? Do you think these moves are setting them up for future success, or are there underlying risks we should be more concerned about? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord link in the description to join the conversation. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.